So our last panel of the day is focused on international real estate investment and development. And our distinguished moderator, Barton Gale, is someone who came to Columbia while I was a student and talked to us several times about the international activities that he's been involved in over a fairly impressive career. Mr. Gale was the Chief Executive Officer of JER Partners until January 1st of 2012. Mr. Gale joined JER Partners in 2009 from Starwood Capital Group, where he served as Vice Chairman of Real Estate. Prior to Starwood, he was Chief Investment Officer for Real Estate at ABP Investment US Incorporated. You can read more about Mr. Gale in your package of bios here. Without further ado, I'll turn it over to the panel.
Thank you. Before we get started, let me just say that I thought that last panel was terrific. I think I was saying that maybe we should just talk about some of the same topics, like housing in other countries, and should authorities be mandating sizes of dwelling units? I say yes, but maybe in the course of discussions you might want to touch on that. Let me make one other fast remark. I didn't realize that Columbia had its own version of Mannequin Peace right behind me. I don't know how many people have seen this. I think it's a food dog, but I'm not sure. He's all dressed up. I just hope he doesn't lift his leg. Let me first ask, how many people here have done anything in the internet, are currently involved in international real estate investing? Show of hands. Wow. Relatively few. Good. As a friend of mine once said, you should always ask what people know, and when they say nothing, you go, well, let me tell you about it. So with that, let me turn it over to my esteemed panelists and allow them to very briefly introduce themselves and, more importantly, their companies and what they are doing currently in the international sphere, and then I'll start firing questions. Shall we? No, we're going to go with you first.
Okay. Yeah, my name is David. My name is David Hotus. My company is Hotus Weill, which I formed with my partner Doug Weill about just under 4 years ago. We've been working together for 12 years, and our principal function has been helping real estate private fund managers capitalize their businesses through raising them private funds, joint ventures, programmatic ventures. Our new business also was formed in the summer of 2009 when there was a fairly significant need for restructuring of funds, portfolios, and management platforms. So the first couple of years of our activity was helping to restructure, recapitalize, and reposition a lot of businesses and the funds that they manage. We operate on a global basis. We have 25 people on the platform operating out of New York, London, and Hong Kong. And we are advising fund managers and investors in those markets, broad geographic regions as well.
Thanks, David. My name is Shuprotim Bhaumik. I'm a partner at HR&A Advisors. HR&A is a real estate consulting firm, real estate development advisory firm. The firm has been in business for about 35 years. Offices in New York, Tribeca, Washington, D.C., and L.A. Our firm has sort of worked both nationally and internationally. I have worked a number of places internationally, including China, India, New Zealand, and right now a current project in Kenya and Africa, which I'll speak a little bit about. Just Gregorio.
Thank you. My name is Gregorio Schneider. I'm the founder of Terranum Capital. It's a fund focused in Latin America, mainly investing in Colombia, Peru, and Mexico. Mainly focused also in residential housing and the retail attached to it. We raised $100 million in the last year, and we currently have almost 3,000 homes, developing 3,000 apartments in Lima and 3,000 apartments in Medellin.
Hi, my name is Peter Ciganik, and I'm a director with GTIS Partners, an opportunity fund based in New York with a business in Brazil. We were started in 2005, and Brazil is more than half of our business. I'm personally a bit of an imposter here since I'm not an alum, but Columbia has been very kind to us, and we've worked with especially the architecture schools over the years, where I've been on the international development class, and the folks there also have made trips to Brazil with us to see our office and our developments there. We've been in Brazil since our inception, and we manage about $1.2 billion of equity committed to development projects down there.
Terrific. Let me just also add that if anybody has a question that they would like to ask at any time, feel free. There will be some time at the end, but you know, anybody has a comment or wants to correct any of us, feel free. Better now than later. I'm going to just ask a couple questions of 2 or 3 of these panelists at a time, and then the rest, in the hopes of keeping this moving along so we can accommodate both questions at the end and some rather lengthy discussion pieces. So let me first start with David and Peter. Given that we have a relatively, let's put it this way, a secular crowd when it comes to international investing, could you guys go over in your mind the 3 major reasons investors should be looking at international investing, and 3 reasons that they may be wary? If you can only come up with 1 or 2, that's okay too.
Should I take the, sorry, okay.
You want to take the pros, right?
No, you know me. I'll prosecute the argument. But look, I think when investors went abroad historically, whether it was real estate or any asset class, usually the first answer you got was for diversification purposes. So I think that continues to be probably the primary motivation for people who are large enough to think in terms of asset allocation. Secondly, I think if you are in a developed market, a mature market like the United States or much of Europe, you would say, I'm going to go abroad to capture growth opportunities in markets that are likely to experience a faster rate of growth. And I assume, since you've all been to Colombia, you know that economic growth is one of the key determinants of real estate growth over the longer term. If you are in an emerging market where a lot of the deep pools of capital sit today, you may go abroad to capture just the opposite, which is maybe more stability, less market volatility, so you would be going abroad to capture stable returns. The other reason people go abroad is they run out of things to invest in their home markets. And while that would never explain why American institutions are going abroad, for example, when Barden was running ABP, the large Dutch pension fund, they went abroad early, given that there was just not that much left to buy, given the scale of the fund. It doesn't explain why Australian investors aren't going abroad, because they have way too much money relative to the amount of real estate to buy, for example. And they just seem to trade among themselves and pay more and more to absorb the flow of capital in country. Those are the pros as I see it.
I think mine are similar, and I would order them in this way. That's where the growth is. That's where our capital is needed and compensated. And that's where we can transfer our skills and knowledge in a pretty simple way from what we know here to a market that doesn't have it yet. And taking those in steps, basically the growth we look at is long-term, things like demographics. In Brazil, for instance, the proportion of the working-age population today is still rising and will continue to rise for about 20 or 30 years. They will peak in 2025. All the developed markets are struggling with their demographics. They are growing in terms of the middle class. We are actually retrenching, and middle class is what creates demand for real estate. So that's the growth equation, and while it's volatile, it actually is a long-term trajectory that goes like this. Second reason is our capital is still needed, and that's pretty simple. We can do projects down there that we develop to high-teen returns, an office building that would yield 15 to 20% return on cost. You cannot do that in in a developed market. And the capital, while it comes in and out, is pretty dear still. There is not an oversupply of capital during most of the time. The third reason that, in particular, we are involved in projects down there is that a lot of what we learned in the US in terms of developing Class A real estate and tenant relationships is directly transferable and applicable. We bring US multinational tenants to Brazil and lease our buildings to them. That's a relationship we have from here. And we also bring architects and developers and the knowledge that we've accumulated here to apply to our projects. There's a lot of local knowledge as well, and you need to blend that appropriately, but those are my 3 reasons why.
Okay, I can't really restrict to just 3 reasons why you wouldn't go abroad. Now, keep in mind, I work with managers who we are helping figure out how to capitalize and their businesses around the world, and most of them are looking to the United States and North American institutions. So clearly, there's a need for capital to go abroad. But let's start with some of the kind of the key reasons, and Peter will be familiar with these because he's been actively, helping build a Brazil business. But the first reason is try to get quality data in emerging markets, and even in some of the developed markets where there's a very different framework for analysis. And for a lot of large institutions, that becomes a real non-starter when there's no way to kind of assess how you're doing from an underwriting perspective, or how you benchmark how you're doing once you get the capital in. That underscores that these markets tend to be a bit more opaque. And in your home market, even if your home market is an opaque market but you're a local, you can usually get reasonable information to make decisions. But if it's a foreign opaque market, it gets that much harder. We won't talk about corruption in some of the emerging markets later. We'll talk about it another time. Emerging markets have some challenges absorbing large flows of capital, and I'm sure that everybody on this panel who's worked in these markets knows that raising capital to go into, say, Latin America, Brazil, parts of Asia, the capital often kind of rushes in. It becomes a good idea. The capital comes in at once. It's not good in a deep market like, say, the UK or the United States. When this happens, we've seen kind of the swings of values as a result, but much more of an issue in some of the emerging markets. The frictional costs of going into these markets can be quite high. Wherever you come from, you've got to find kind of your way in, putting aside whether you are hedging your exposure or not. More expensive to get in. The fund managers typically want to get paid a higher level of revenue, fixed management fees, et cetera, because it's expensive to build these platforms. You've got partner risk because you're going into markets where there may be kind of less mature sort of market, and there is perhaps a less deep pool of people who have been doing what you want to go do there for a reasonable period of time. And lastly, timing your entry and exit. If you are in your home market, your knowledge is going to be better. You're usually not quite as hung up on when you can get in and when you can get out. We've seen, for example, in China, sometimes very difficult to exit, sometimes difficult to repatriate. So those are kind of the issues that really come to fore when people start saying, why don't you go abroad? And I know other people have probably their own experience.
Let me just comment on that. Leave Peter to, on the high ground. What's interesting, David, you didn't mention currency.
Frictional costs.
Frictional costs, yeah, they may or may not be. You don't necessarily have those, but as you mentioned, your last point was really important, I thought. In particular with respect to emerging markets, but it's the same hold true even for developed markets. You have to be wary about the currency. So we're going to go on those in a bit. But let me just address, if I can, I think David did a great job of hitting, a quick laundry list. How many people here in investment management deal with portfolios, pension funds, endowments? Anyone? Oh, interesting. Okay. The vast, so we really need to distinguish between opportunistic, one-off, I'm an individual and I want to make a pile of money relative to what an individual can make by buying or developing a flat, a block of flats, a hotel, an office building, investing in a single housing development versus a systematic program of investing. Very typical if somebody's opportunistic and they just go, wow, I just want to make a lot of money, and my cousin Bob lives down in Brazil and he told me about this great deal, then your investment considerations are very different. But having said that, most people don't have an infinite amount of money, and even that investment they have to take into consideration with their entire bucket of investments. So to me, one of the reasons to be wary of investing is this diversification argument. Are you really ever really achieving your goals of diversifying to an extent you could not otherwise diversify to the same degree, matter of fact, to a more efficient degree when you're taking into account things such as all the risk factors. And David did a job of talking about all those risk factors. In other words, Are you better off just investing in the stock market of that emerging country, of that developing country? Are you better off just investing in bonds in the U.S. if you're a U.S. investor, or investing in private equity if you're a U.S. investor? Are you getting that same risk-return kick without some of those additional issues that you have to confront when you do overseas real estate investing? I think this applies across the board. Did I kill that one?
I think we need to let someone respond to that.
Well, okay.
let me jump in. Okay. So I think, you were touching on some of the risks. I think, at least for us, before anything else, is about the partner. In any of these countries, I think the first line of defense is a partner. Difficult to, you talk about allocators versus operators. In the case of, we're dealing in 3 countries. We cannot be operators in each of the countries, so because it's such a local business. So what we need to do is allocate to developers in each of these. And I think, as I said, the first line of defense is a partner. Second is about the currency, that we'll touch on that later today. And finally, it's about the exit. For us, I think the partner is, we spend a lot of time doing due diligence on them. I think I think that's what makes or breaks any of these transactions, any of these investments.
What's interesting, Greg, where are your investors from? And you're doing transactions in Peru and in Mexico, Colombia, and all those. Where are you mentioned this, so where are your investors from?
I think for the first time, I've raised funds in the past over the last 10 years to invest in emerging markets. For the first time, our investors are local. So I would say 70% of the investors are Peruvian, Colombian, are all Latin American. The pension fund system in Latin America is very strong. So you have $500 billion of pension fund money, with a very small percentage allocated to real estate.
So for you, your risk is the same as an investor investing domestically here in New York. If you want to go do an office building here in New York, and unless your name is related or Fishman Spire, you better have a good partner to do that with. So you're confronting those same things, but for sure, it's even more important if you're David trying to do something down in Peru, representing the overseas investors.
Yeah, I think for us, for the first time, we have an endorsement from local families. The local families usually have managed the real estate business in Latin America because interest rates were very high. So the only way to protect your assets was through real estate. So, when I was growing up in Mexico, you would either put money on real estate or dollars, because the currency would devalue 100% every year.
So Peter, do you consider yourself a local operator, or do you, are you a hybrid? What are you?
We started as a hybrid, working with partners, and over time we've learned that we were actually better at a lot of the things than the local partners, and that goes to one of the risks that David mentioned. We've transitioned our model to actually developing properties ourselves. We still have partners on the residential side, where you deal with a lot of people, like buyers of your units, and we don't want to have large staffs dealing with retail, basically. But on the office side and industrial development, we develop our own buildings today. And that's driven by the partner issue that David mentioned.
I think Peter's making a very important point. One of the rationales for having kind of a North American manager go into another market is to bring kind of North American building standards. And so it's entirely logical that GTIS would start by working with locals, but then in order to really ensure that they could create the quality of product that a multinational corporate tenant is going to desire, you end up creating your own standard. And we've seen throughout the world, just the issue of, in a lot of the emerging markets, the quality of the product is just not up to standard, which we'll come on to in a second. And then I think Gregorio made a very interesting point, which is the presence of local pools of capital, institutional pools, the pension funds, as you said, with hundreds of millions of dollars. That to me, has always been one of the key determinants of when is it okay to go into an emerging market. And part of the answer to me has always been when there's somebody in the market that's big enough that can buy, because you can't always rely upon the foreign investor coming in to buy your finished product or whatever it is you're building.
Well, I find what's interesting is what Peter just said earlier about there's still room for foreign capital in Brazil. What was interesting, now that I think you may have to go through certain sectors of the market. So for example, retail, you can argue there's room, there's not room, but that's now been priced to a more than a full, a full international standard. The cap rate for a mall, a good mall down in Brazil is 6.
Yep.
Yeah. So I mean, that's what you're buying them for here. So one, I forget who it was. Texas Slim or somebody said, if you're playing poker, you don't know who the schmuck at the table is. It's you. And that has been one of the real issues that these gentlemen have already mentioned. The lack of transparency. Understanding some of the issues about Box A, Box B, which I'll ask them more directly later. But each of you, could you very quickly respond to me? Well, David, you can sit this one out. How critical is getting overseas capital to getting deals done in your jurisdictions now?
So, I can speak to sort of the work we're doing in Sub-Saharan Africa. It's really important. I mean, sort of some of the deals that we are seeing over there are essentially. Let me step back. I mean, in African parts of emerging markets, sort of there's a tremendous sort of degree of sort of, again, middle class growth and also urbanization going. I mean, so if you look at some of the projections going out, they're saying, by 2050 or 2060, large portions of these sub-Saharan economies, 50, 60, 70% are going to be urbanized. So there is going to be sort of, when you sort of follow that trend, there's a huge demand for sort of at least 2 basic sort of asset classes: retail, good quality retail, and housing. And some of the deals, some of the projects that we see coming along are almost all projects which have a significant degree of overseas capital. Because a lot of those countries in Africa have...
This is on development.
This is on development. And a lot of those countries obviously have colonial past, so the money is either coming from London or France or some of those places. South Africa is a huge player. And the way some of those deals are working is...
But who are those investors? Are they governmental authorities? Are they private individuals?
No, they're private equity firms investing. There are banks investing which have infrastructure sort of businesses as part of those. What we're seeing on the development side is actually kind of interesting, because one of the things which has happened in some of those sort of tier 1 cities is land prices have just gone through the roof. And because sort of the regulatory environment, the proprietary sort of land sort of...
Outside of South Africa, what are those cities?
I would say, you would say Accra, Ghana. You would say sort of Lagos, Nigeria, Nairobi, Kenya. Major sort of tier 1 cities are seeing a lot of sort of escalation in land value. So a lot of the local sort of partnership is coming on with people who have free and very clear rights to land, because having sort of clear rights to your piece of land is very important in that context.
So the opposite of India.
The opposite.
So let's just
actually the opposite of a lot of emerging markets, where sort of the regulatory environment is still not there.
Yeah. Well, we won't get into those details unless somebody wants to. But so you're working on a project in Kenya, yeah?
Right.
How is that being capitalized? Is the land being contributed by the owner in return for either part of the overall profits or for segregated square meters, or what? And then where's the money coming to build? And as David says, and then where's going to come the money to sell?
So
take us through that.
Yeah, typically sort of what we are doing in this project, what we typically do is sort of complex sort of public-private deals. In this case, the government has actually acquired 5,000 acres of greenfield land outside Nairobi.
The government acquired.
The government has, which was primarily sort of low-grade agricultural land at a very, very minimal cost.
To do a master plan community.
So do an entire master plan city, technology city. So what the government is really doing, if you can think of the government as sort of the master developer over here. So the government is essentially leveraging the value of land, putting in the infrastructure and leveraging the value of land. And then over a period of time, we'll use the value of land to essentially finance the infrastructure that needs to go in. And the idea is, as you put in sort of world-class infrastructure, get in sort of world-class developers and world-class tenants, So that's going to be sort of a...
So the government is going to provide improved parcels, you know, roads, water, sewer, maybe even a school, a shopping center, fire department.
We're trying to stay away from the schools and the shopping centers because there are only very few things the governments anywhere in the world can do right. And certainly, you know, the government can't do sort of...
Well, they can certainly build the buildings.
They can certainly build the buildings.
So where is the capitalization going to come for these developers who are going to come in? Where's the money coming from them? They say they better bring it in a satchel, or is there local
I think there are
local sources? I didn't mean that way.
Yeah. there are some people who are going to bring in satchels. I mean, there is you know, there's significant amount of funds coming in from other parts of Africa which are more unstable, more war-torn, so to speak. You know, Somalia and all some of those places in sort of North Africa along the coast. There's a lot of Russian money coming in as well. Chinese money coming, especially on infrastructure development.
But to do the city, you're going to need hundreds, if not
billions.
Okay. All right, it's going to be a challenge.
It's going to be a challenge.
Greg, you want to take a? Can you run through the same kind of like how things get done, who pays for it?
I think in Latin America, I think governments realized that they were very inefficient in just developing housing. So what they did is they changed the paradigm and started creating programs to subsidize mortgages. So what they do is they, you know, Colombia, Mexico, Peru, Brazil, they have programs of affordable housing mortgages. And so what they do is they created this massive amount of demand, and the problem now is on the developers where they don't have enough capital to build. So really the challenge for them is to buy land, and that's where they need a partner like us. So what we do is we go together with a developer that we have done due diligence before. So we buy a piece of land, we put it in a trust. And the first mile, that's a problem. Land and infrastructure and urbanization, that's where there's no capital. Banks don't lend, and they don't have enough capital to keep up with that demand. So that's when we come in, we put money, and then the pre-sale starts. Mainly Peru and Colombia, these are a pre-sale market. So the way we capitalize it, we get sometimes, you know, to start building in Peru, we need to have 30% pre-sales of the project. To start the second phase of a project, we need to have 70% pre-sold. So that's the way we capitalize it. So if you have between 30 and 70% pre-sales, then the bank lending comes in. So banks are really inefficient, and that's really the opportunity for
Are you using the buyer's deposits to fund
Not only
against
that,
the bank guarantee?
In the case of Peru, they give you 100% of the sale in 90 days.
Up front. Wow.
Up front. So, you know, that's amazing, right? You think about the amount of equity.
Let me just make an important point here. When we start talking about real estate in emerging markets, and this goes, you know, even for, you know, India, China in particular, the vast majority of activities are in housing, and therefore it's kind of manufacturing, whereas in developed world, when we talk about real estate, we talk about income-producing real estate. So it's one of those things people forget about. They say, I'm going to go invest in, you know, international real estate, and then, wow, next thing you know, they're speaking of cyclical game, you know, they're invested in housing, in manufacturing of housing, with a tremendous amount of governmental intervention, both benign and malign. David's going to try to disagree with you. No, he won't.
Just a bit, because it is shifting, particularly in, say, China. We're seeing it not as quickly in India, that governments is not trying to encourage quite as much housing, because they realize that if they fund their budgets by selling land or leasing land, they're not creating a local tax base. And they did that for a long time, and they created a lot of housing. It wasn't necessarily efficient, whereas the direction seems to be more toward master planning, because then they're creating an infrastructure where you'll have commercial activity, you'll have retail, you'll have the industrial or logistics that's supporting it, and then the housing too around it. It's not a huge shift yet, but the residential is driving it a little less. I never disagree with Barden because he's older and therefore smarter.
You left all the others off. Okay. You want to, so in these Andean countries as well as Mexico, how are you pursuing anything other than for sale housing? And if so, how's that getting capitalized and moved? And then Peter, it'd be really good for you to give that, you know, the evolution. Right.
I think for us the focus is housing and then the retail attached to it, so street centers. So we develop a community with 1,000 apartments. The problem is that sometimes they're far away from commercial areas.
Yeah.
Of course, we try to concentrate close to cities, because for a long time in some other countries like Mexico, they develop, I don't know, 20,000 home development, but 3 hours away from a city. So people don't want to commute, so they become kind of sleeping cities. So now the development of vertical, it's kind of priority for all the governments. So they're subsidizing mortgages more to vertical than horizontal. And of course, you need to put some retail. But for us, it's really 80% housing, 20% retail, and it's all for sale. So just to emphasize the point of exits.
You're not holding on to the retail in your project. Are you selling the stores off individually, or are you selling them, that little block of, 1,000 meters to an investor?
Going back to the point of local liquidity, now pension funds, insurance companies are willing to buy the strip mall.
They'll buy the strip.
And they will buy it, and they will buy a portfolio too. So once we stabilize it in a year, then we would sell it as a portfolio.
Terrific. Peter, could you give us a
Over
little
time.
bit of the history and as well, the evolution of GT Golden Tree, and what it first started doing, what it's doing now, and the evolution of the funding over the how many years? Well, if you
been about 8 years.
If you take the founder, well, you kind of have to add on. Tom Shapiro is the founder, and he was with Tishman Speyer, who so he first cut his teeth down there with Tishman Speyer, doing projects as well. So you kind of have to tack that on to the experience, if you will.
Yeah. And that goes back to your schmuck theory, because while we were, a relatively young bunch, optimistic Yankees showing up there trying to make investments for the first couple of years, we did not think we were schmucks because Tom's experience was long-term. But I'm virtually certain that people across from us at the table thought that we were schmucks. The technical term in Brazil is gringos. And just dealing with that, we realized after a couple of years that helicopter investing out of New York with the three of us trying to make deals work was less than efficient. And so when I say that we today develop our own projects, it's actually local hires that we've made over the years, senior folks who have been in that business for 30 plus years down in Brazil. And so that's how we do things today. We wouldn't be able to do that out of New York, but that's just on the schmuck part. In terms of where we or how we finance the project, it varies by property type. It's very similar on residential, where we take pre-sales and those fund a lot of the construction. You can use deposits.
That's the way it started, and that's the way it still is. Correct?
It still is, right. Correct. You can use deposits, unlike in the US, for construction in Brazil. The flip side of that is that if you don't deliver the building that you agreed to deliver, it's actually a criminal offense, and people have gone to jail for that. So it's a pretty good way to actually finance a building, because if you think about it, unless it pre-sells, therefore there is demand for it, it doesn't get built. Therefore, there is rarely a huge oversupply of units. The way that the market adjusts is not through fire sales of units like the condo debacle in Miami, it's through not having supply because they never were able to build. On the commercial side, that's where our capital is dear, because everything in Brazil historically has been done through strata titles. What that means is that every floor in a commercial office building was financed by somebody else, by a family, by a private investor, and there are 20 of them financing a structure of 20 floors. That has its headaches, as you can imagine, putting that together as well as managing it. They can never agree on who they should lease it to, for instance. When we come in, we actually do it on spec. And there's just no one in Brazil today even, and certainly not 8 years ago, who could put $300 million into a spec office tower as we did. And when you can build it spec, you can get better tenants. You can drive what you are actually putting there in terms of specs, and you build it to a Class A standard. Then, tenants like Facebook, Credit Suisse, Louis Vuitton are comfortable with, and then that's where your return is.
Well, I mean, I can think historically it's been Hines and Tishman Speyer built the first spec,
yep.
Unified. But when they started building, which is, a dozen years ago, if not longer, there was no takeout. There were no pension funds. So now, yeah, you're getting the capital to. Are you getting bank loans to?
You were selling floor by floor, so you didn't.
Not Tishman and Hines.
We're actually selling the entire buildings. There are few but very interesting realizations now in our portfolio, and the buyers have been both local and global. Sovereign Wealth Fund bought one of the office towers, and another piece was sold to BR Properties, which is a publicly traded Brazilian real estate company. So that's been our exits on large projects so far.
On the industrial side, you dabble in industrial?
We do. We build warehouses, and those are either sold as individual condominium units or hopefully we're actually amassing a portfolio that we're hoping to bring to market as a cash yielding, income producing property.
Not
We'll
converted to a publicly traded company, a REIT, or have you?
We have not, depends, will, remain to be seen. But I think we will probably be able to sell the portfolio to another REIT rather than structuring our own.
What's been interesting about Brazil, which I've been tangentially involved with for over a dozen years, is this evolution, but it's long. So if you're early into the process in an emerging market, and you better have a very long, a lot of oxygen in your tank if you're going to do something as brave as do a 500,000 square foot office building, which a couple of these things were absolutely gorgeous, but there was no known takeout at the time. Now, with the evolution of REIT structures in these various countries, I think that's going to accelerate, and I think in Peru and Colombia has a REIT structure, doesn't it?
Colombia has one REIT.
But it have a REIT structure, which means you can have others.
Correct. Yes, but there's only one for the last 5 years.
One for the
and Mexico just changed the law last year.
Just changed the laws, and that just
has
started.
2 right now. Well, has 3 that have been listed, and they've been a massive success because you can imagine for years and years, families or institutions have been accumulating properties, and suddenly you can flip them into the capital markets.
David, you want to do?
Yeah, I'm going to play a little devil's advocate on the public market exit, and you knew I would. So, not just in emerging markets, but in a lot of developed markets, you've seen a kind of a proliferation of public real estate securities, creating REIT structures throughout Germany, Japan, rest of Asia. And that has not necessarily been kind of a smooth transition. Now, it didn't help there was a global financial crisis in the middle, but even before that, what you found were private equity real estate funds that were using public markets to exit. And they would, typically you could sell, they would be the high bidder because, their cost of capital theoretically was lower. But when we talk about, kind of the timing considerations of exiting these markets, when you add in the fact that now your exit is into a public market vehicle where there is inevitably going to be some term of lockup, it has created some misalignments. In Germany, for example, everybody aggregated housing and sold it into a couple of very large companies, and I think some investors are still trying to exit. We saw this in Japan as well. So while it is, again, over the longer term an opportunity because it creates a domestic pool of capital to buy your real estate, and in a perfect world, public real estate companies have very good access to capital. But it is by no means, sort of entirely simplified the whole issue of timing your exits.
No, I absolutely agree. I mean, that's absolutely right. I mean, just because these structures exist, just because there are 2 traded companies or a half dozen traded companies doesn't mean you have an exit when you want to have an exit. There are reasons that people love to invest in the U.S., the UK, Germany, because these are deep, liquid markets, and the reason they're liquid is they have well-defined capital markets. My point vis-a-vis Brazil was, a dozen years ago, there was 0 on the horizon with 2 public company accessions, both closely held. Now you've got a little more, it's opening. Plus, what you also need, you can have all the public companies you want, unless you got individuals and you got institutions buying those stocks, you got no liquidity underneath. So you do need a rising, a growing middle class. Well, let's, before anybody gets off the hook here, so let's talk about a couple of those risks. To my mind, still the 2 greatest risks are, especially dealing with emerging markets, which, we can talk about developed markets, we can talk about France, Germany, the UK, Japan, Australia, but you want to know something, if you're here, you kind of know those. Obviously they're different, but you kind of know how they work. So the emerging markets really do proof all of your investment skills and assumptions. So let's talk about a couple of those. To me, when I was investing, my single biggest issue was what I'm going to do about currency risk. Currency risk, wraps in inflation risk. It envelops. What's the word I'm looking for?
Well, it's all
event risk.
It's all the macro risk.
Political risk. It's all the macro risks are in there. And the question, if you could hedge it, how much would it cost you? All right. And then is it worth hedging? And now let me look at my returns, either net of that cost, either actually doing it or not doing it. Either way, I got the cost. Either I got the risk or I got the cost. So we got the currency, and at the same time, also wrapped within currency is certainly to a degree corruption, but corruption, shows itself in a couple of forms. Like I said, the benign form, which is, it's like who knows who, and you got to do somebody a favor, and it isn't thing that's going to get you arrested on the Foreign Corrupt Practices Act, but it's kind of that borderline.
Nothing that doesn't happen in New York.
Nothing that doesn't happen in New York. Fair enough. We can make it go slower, we can make it go faster. And then there is the issue of what do you do about real corruption. So why don't we start down with Peter and come back this way. Talk a little bit about currency and if you want, if you want to give I love your I can build to a 13 return. But when you take a look at interest rates, and when you take a look at currency risk, you go, what is that really in a dollar return?
Yeah.
Okay, so if you can hit those two, and then maybe comment on after you adjust for those, which you're better off buying, the Class A in Rio or Sao Paulo, or the Class A in, let's make it a little better, Chicago.
Mm-hmm. Well, currency is, a huge question, and one that I always get, because when I say we invest in Brazil, that's the country with the craziest currency that probably is out there.
That's why they call it the real.
I know, the real currency, right? Everything in Brazil is nominal, forget about real. And it grows, and it is inflated, and it's a headache. I kind of like David's way of putting it, that it's the risk of timing the exit. I'm going to use that instead of currency risk, because it's really about...
Right, because if you get your timing right, the currency will
currency
be where
helps.
you like it to be.
And we've seen it in our portfolio where, the early projects when the real was appreciating actually probably added about 3 to 5% of IRR to our projects, maybe a little more. That's massive, that's substantial. That's a 20% gain in the currency. Lately, it's not been doing that well on the currency front, and we probably are suffering a 2% IRR drag on our projects because purely of the currency. And frankly, we were not the best in managing our currency exposure, so our first fund was hedged. We offered an option to investors to hedge the currency, and I can explain how we try to do it if it's of interest, but we kind of gave up on it for two reasons. One, we weren't terribly good at it. Don't tell anybody. Two, the investors we have kind of have started looking at a currency overlay over their entire portfolio, and when they have other investments in Brazil in agriculture, private equity, public equity, they took that exposure into account and are doing the hedging themselves. So in our second and third fund that we are now not actually hedging anything other than what we call natural hedges. And that may sound like a weird concept, but basically there are three of them. One, we try to buy the land in a land swap, which means not paying for it up front. We agree with the land seller that we will pay them once the project is done out of revenues, and that has a natural hedge because we don't convert our dollars to buy the land. They ride the curve with us, and we only pay them at the back end of the project with the currency volatility baked in. The second thing we try to do is a similar concept. We do installments. We pay people over a 12 to 24 month period, and that kind of dollar cost averages our cost of buying the real. And the third thing we try to do is, to the extent we can, get out at the right time. But that's why I like David's time of the exit is of essence here, because if you need to sell and if you finished your building and it's developed, you face a choice. Do you keep the building running and get a good yield, which is available in Brazil, or do you sell it at a time when the currency is not in your favor?
Housing, you don't have that choice.
In housing, you're cranking units out, correct.
You just got that. You hope it's
Correct.
a short window.
Yep.
In our case, in Peru, Colombia, and Mexico, we hedge. So we buy options, 1-year options on the currency, and we keep on rolling it. And based on the value creation that you have every 6 months, we adjust that hedge. And then when we're selling units, we just reduce it. And that's, myself, I come from the hedge fund world. So I always hedge my portfolio. So that's the reason.
But you said a lot of your investors are from the locals, so they're not hedging, unless you're.
No, but we're hedging because we're a dollar fund.
So they're investing in dollars in your fund. You're turning around and then investing locally.
Correct. They want to get out of their currency.
Because a lot of the Colombian investors, they're investing in Peru, so they don't want to take the sole risk. They're fine in Colombia, but they're not fine in Peru, right? So.
And how much does that cost? I mean, the cost of hedging.
Today, hedging 5% out of the money, more or less 2% a year.
2%.
And the hedge is good for a year?
Well, yeah, but you need to keep on rolling.
I understand.
Yeah.
Your point is in stable world currencies, you can hedge much farther out.
Yeah, no, here the maximum you could hedge is a
Most
year.
emerging markets, if you can hedge it all, it's 1 year.
What we would do,
rolling,
we look at the curve and we see if 6 months is cheaper, we would do 6 months and then roll it again.
and then rolling it.
But investors are very happy because I think the experience in Brazil last year was terrible. So investors that invested in a building in March, in April, they lost 25%. Because the movement from 1.6 to 2 was massive.
So Shuprotim, so just using Kenya, is this, like when you're doing all your feasibility studies, is this like, okay, first, is this your first question? Can I find the money? Or is your second question, can I hedge it?
No, I don't think sort of, again, I don't think sort of the hedging piece comes up. And obviously the first question is there demand? And the answer is yes, and the second is, okay, can I build a product to a standard which I want to build it to? But let me just start in terms of risk. I'm not the currency expert over here, but so to me sort of to me the big risk, at least the way I see it, in some of the emerging markets I've worked on, is sort of the political stability risk and the legal transparency. Because in as much as the foreign investors are coming in and teaming up in most cases with sort of local entities to go and do a project, a lot of the stuff which I've seen happening on the back end, if things don't go swimmingly, as they've all sort of initially envisioned, is what happens with that investment? How do you take sort of legal recourse? And there is a rule of law, and there is sort of everything else on the books. But if you're ever in one of those projects which end up in some kind of litigation or anything else, that to me is the biggest risk that at least to me again, that you could take for some of these foreign investors going in.
David, you want to?
Yeah, I maybe this is more controversial than it needs to be, but when people think about investing in emerging markets, the first point is, if you're the chief investment officer of a large pool of capital, you probably don't want to hedge your real estate if you're going to the emerging markets, because one of the things you're doing is you're looking across a large pool of assets globally. They're in all sorts of different instruments. And whereas, the real estate bucket is typically, priced and benchmarked around real estate, the entire portfolio is priced against probably some kind of a global index. So a lot of investors have gotten comfortable with the idea that, not that it doesn't matter what happens within the real estate portfolio, but that they're thinking of it from a broader perspective. Now, where the rubber meets the road, though, is you've got fund managers who are creating dollar-denominated vehicles, and so therefore their compensation ties back to investing in dollars, taking dollars back, putting profit in their pocket in dollars, and that is where there have been some kind of mismatches and misalignments from a currency perspective. The other point, and this is, I think, part of the problem we're facing kind of globally in capital that goes into emerging markets. The first emerging market deals came out of opportunity funds. Opportunity funds are designed to
make money for their sponsors.
Buy, well...
Oh, I'm sorry.
Buy, fix, and sell, develop, fix, sell, whatever. Get in, get on, get out. That's the theory. Emerging markets, by their very nature, will be long and unpredictable. Therefore, why take capital that is designed to have a 5-year hold, go into markets where 5 years is a fairly arbitrary period of time, especially given that most of what you want to do in these markets is development, because a lot of what's there you don't want to buy. So have we created our own problem here with this whole issue of timing, which then ties into how fast does it really grow, how quickly can it really absorb capital, what's happening in the currency market when it is naturally done. And investors look at this and they keep saying, well, I go into opportunity funds to get a 20% return. If I'm going to develop in an opportunity fund in an emerging market, I should get a 30% return. The only way you can do that is to get in and get out quickly. You can't get a 30% IRR over a 10 to 12 year period. And so therefore, we have to kind of rethink it from the top down where the capital is going to come from to actually do these very long dated projects, because you'll never get the timing right when you are considering development is unpredictable, government support or not is unpredictable, global capital flow is unpredictable.
Well, I got to say, to me that's a little, I think if you get the land right, what's interesting in places like India in particular, the land component of a development is relative to the actual construction massive. And then it can take you 20 years to build out this project, and you're getting buried because of all the hiccups along the way. If you can get the land right, like it's contributed, as Peter was talking about, that's an interesting approach if you can do it. One of the other ways that we didn't hear from these gentlemen, but other people have done is on the commercial side. They're renting space to multinational tenants, and especially warehouses, occasionally retail, as well as offices. In dollar-denominated leases, and all of a sudden that's of course a great hedge. Okay, and it's a great way to make your life a lot easier, and then you can even sell it to some dollar investors. Can we? Any questions out there? Nobody interrupted, which I'm sorry to hear. Yeah. Sorry to not hear.
Quick question for Shuprotim.
Yes.
How are you advising on exits? I do some work in Nigeria. How are you advising on exits within that space?
Well, we haven't really sort of come to that place as yet. Sort of, our role is again, this is a public-private sort of project. Our role is advising the government of Kenya on this. So what we are right now engaged in is not so much the private sector, but helping the government of Kenya figure out the capital that it needs for the upcoming infrastructure. So we think over the next 5 years or so, the government of Kenya will need up to $1 billion in infrastructure. Now we think from the land that the government has acquired, and by putting in the initial infrastructure, it can create some kind of a, quote unquote revenue bond, which will pay for a quarter of that money. But the rest of the money is what we're going after, and I think sort of it's going to be a combination of soft loans from the African Development Bank, if you will, some Eurobond denominated sort of loans that the government can take out, where they have some certainty, investors have some certainty, and potentially we have talked to a lot of banks, the big infrastructure banks, the Actuses and the Stanbics and the Macquaries of the world, who are willing to invest in infrastructure, both as infrastructure bonds, as well as through public-private partnerships with big infrastructure companies like the GEs of the world and the Siemenses of the world from a project financing perspective.
And for David, could you, I went to a symposium at Reuters a couple months ago, and there was a Senator Ian Scott from Delaware, I think it was, that spoke on the misnomer about the corruption. Like you said, listen, it happens in New York as well. I used to be in the construction industry for a long time, seen it. And could you talk more on that? Because a lot of people are basically fearful for entry because they feel that corruption is so blatant that it doesn't make sense for them to enter. I mean, the same thing was in Brazil, India, and it's less so than...
India, New Jersey.
It's a good thing I don't own a car. Do you own a car? It's about to be.
Right. There's no good answer to this. A lot of fund managers, take a blind eye and say we have local partners, and they step back from it. But the penalties are very severe, and I don't know how you avoid it. And when you take a blind eye, you're also taking a view that it won't come to light, because if it does, you've got your own liabilities. I think it is improving in some markets slowly. I think the Latin American markets, it's improving. I think that China is actually improving, given that they themselves are trying to fix some of the problem. But investors are not going to be very patient about that issue. And I was curious here that in Brazil, a real estate developer can go to jail for not delivering what they're supposed to deliver. Imagine that here. That would be an interesting turn of events. But if I'm a fund manager in North America and I'm doing a project in China, and it's clearly people that I should be supervising are doing bad things, I'm very liable for that. And people create a lot of kind of compliance And we think about compliance one way, and with no disrespect, fiduciary standards and mentality about compliance is very different around the world. And we just there's no good answer. Sorry, I gave you a long, not good answer.
Thanks. Barton, just if this is an inappropriate question, let me know, but we haven't talked a lot about, it is, okay. It's not that kind of inappropriate, but it's more of a design question. I know we spent a lot of, okay. I know we spent a lot more time on capital markets, but, and people who know me know that my background is actually not, you wouldn't expect me to ask a question like this, but it's probably more my upbringing. As I think a 20-year-old kid in college, I was asked to read a book called Jihad versus McWorld, which was largely a forgettable book, to me at least at the time. But it discussed these two opposing forces at work in the world, which is the idea that, to put it simply, the rest of the world wants to become more American culturally, but at the same time, and you see it every day, for example, with the Arab Spring, there are still largely traditions that that aren't going to be forgotten very, very quickly, especially in the emerging markets. And as a kid whose parents are from Iran, and by my friends having grown up in Memphis, Tennessee, I'm kind of known as the first Persian redneck amongst them. So it's always kind of been a conceptual discussion that I'm sensitive to. And I wonder, as you guys think through the design stage, especially in a new market, like an emerging market where largely American concepts are still very new, or Western concepts, have you found yourself coming in, and again, being a New Yorker, if you will, or being from DC or wherever you might be, do you find yourself at the design stage being sensitive to those issues, especially when it comes to retail or residential? And have you ever crossed that line and I don't mean to make a political statement of American arrogance, if you will?
Well, it's interesting. That's really a question that I would direct to Peter in particular, and Shuprotim as well. Maybe a little less because I don't know how much experience, but one of the questions I first asked when I went to Brazil, so what are you guys doing different? Are you bringing any, I appreciate bringing construction expertise. Is there anything you're doing, anywhere inside these units that you would consider to be American? And you can answer that, and I can give you my broad experience in a second.
Sure, I'll try. Culturally, Brazil is actually very similar to the US in the sense that it's one of the most multinational country with very diverse population, and they actually kind of want you to win. They're not opposed to foreign concepts, and Brazil, in that sense, is a good place to do business. In very sort of property type specific view, they do things differently, but they appreciate the US concepts and the quality that we can bring to the market. And I'll give an example on the residential side. They actually have very good concrete development standards. They work a lot in concrete.
I think it's more toward the design. So,
that goes with the design. If you go to Sao Paulo, almost it's a sea of high-rises, and they're all concrete high-rises, either residential or office, and they're good at it. When you think of classic commercial space, though, what you want is a glass curtain and a core and an efficient floor plate.
What about on the residential side?
We actually don't try to impose US concepts on the residential. We just work with partners on the residential, and we kind of build what they are used to. Maybe we up the standards a little bit, and I think we built, the premier residential tower in Sao Paulo that was finished last year. Certainly it had the highest grossing sellout in terms of prices. And it's not that different from what they built, it's just a little better on the residential side. Concrete construction, brick, fill-in, pretty typical. Very different on commercial side, though. That's why I want to sort of go there. They are not very good at steel. They've never been. They don't do curtain walls. We had to hire KPF out of New York to actually do that properly. And we had our design folks and our asset manager present on site all the time to make sure that that curtain wall gets done properly. And it's one part of the value delivery that we provide, that you can actually have see-through floors that are well configured. Am I addressing what you were after?
No, I was just remembering something. It's interesting. My experience, I don't know, David, Shuprotim, pretty much you're building the local market, and if they want bidets, you're going to give them bidets. If they want bright colors, you're going to give them bright colors. If they want tile in the kitchen, you're going to, it's. I don't know if there is a, the American dream was always, the 2, 3, 12-car garage, and that ain't happening. So, But
You haven't been to Saudi.
I haven't. Yeah, I have. What I found to be very, very interesting in an opportunity in my early years in Europe, especially in Spain, were the commercial construction standards where high-rises had not been developed, for example, in Spain. And in order to build the hotel, well, I guess it's called the Via Arts. You know, it's the Ritz-Carlton right on the Via Olímpica in Barcelona, if anybody's ever been there. We had to get the fire safety laws changed. It used to be that in Spain, if you were going to go above 10 stories, no, even 4 stories, because I once went to a hotel in Marbella, their fire escape wasn't a fire escape, and it wasn't a pressurized stairwell, it wasn't concrete construction, it wasn't doors, it was a sock. You would jump into this sock and hope that the friction slowed you down by the time you hit the bottom. Now that guy, I guess, was sort of okay in a 4-story building, but if anybody knows Barcelona, you know, there's something called the Heron Towers right in the middle of the town, very distinctive towers that were ugly, now they're even uglier. You can't believe it. But, you know, when I was touring these things, you know, you were looking at the common areas, and I opened what I thought was the John, and I looked down, and there's like a manhole cover there, like, you know, a trash receptacle where you pull the thing up and you can throw your garbage in. I said, "Was that garbage?" He goes, "Only if the fire's really hot. That's our fire escape." I said, "Does that really work?" He goes, "No." So what's the problem? He says, "The problem is if more than one person is in the sock at a time, the friction gets dissipated and boom, you know, everybody's just jumping."
Jump last.
No, you don't want to be last. You want to be first. Or maybe you don't. You know, it's a kind of scary thing. But there was a long education process in the Via Olímpica where, you know, said, listen, to do that and have a modern high-rise tower, you're going to have to change your fire safety laws. Otherwise, we can't do this, period. And it took a tremendous amount of time to get that jurisdiction to agree to the standards. And then that would also go to similar construction standards, because if you're going to do that, you need to do your fire, you know, you're going to maybe do a different kind of construction, and you're going to have different kinds of egress, and, you know, so on and so forth. So it really changed how hotels were built in that particular country. If that kind of, does that?
Barton, if I just might add, sort of stepping back, even in the planning processes we go through, you know, we go there, sort of, let's say we're doing a new town somewhere, and whether it's Africa, Asia, wherever, and, you know, we bring our sort of, you know, US and foreign trained planners, and we all talk about sustainability and walkability and things of that sort, often forgetting there are issues about climate. In some of these countries, it's just too hot 8 months of the year to actually get out and do anything. There are questions about security. You know, you know, walking on the street, you know, at any time of the, even, you know, late afternoon, early evening is not. I mean, in Nairobi, for example, wherever we are told to go, even if it's like, you know, half a mile away, we are told to get on the car and go somewhere there. So there are some real issues even before we get into buildings. You know, the planning stage, we start thinking about some of the principles which we instinctively are so used to thinking about as we're thinking about new towns and new cities and new neighborhoods, that we really need to think through and how to sort of, you know, customize and apply them in sort of that sort of setting, if you will.
I love that climate point because half of the stock in Sao Paulo doesn't have central air conditioning. And if you've traveled there in the summer, it's hot. So can you imagine if we built to Brazilian standards and then asked Goldman Sachs bankers to actually work there? I don't think it would work.
Well, yeah, I mean, I was financing a building in Luxembourg for Arthur Andersen, and they showed me the plans and specs. And I said, wait, what kind of treatment is this on the floor? He goes, that's asbestos tiling. I said, not in this building. I mean, this is 1990 whatever. I said, you know, and oh, likewise, there was no central air conditioning. They said, well, we don't, you know, everybody loves fresh air. I said, you may love fresh air, your machines don't. So we had two things. He said, in order to get this stuff financed, which goes to your point, or sold, I said, you got to build this to an international standard, an institutional. That goes a little, so we've given you way too long an answer probably on your question. Any other questions?
Unfortunately, we're going to have to call it a day.
Well,
on.
I got to ask David one question.
Sure.
All right. So, you know, we've had this long discussion, pros, cons. So what are the big institutional investors doing today? And by that, we're talking really about U.S., Canadian, UK, and some Germans and French. Where are they putting their money?
And Dutch.
And Dutch, absolutely.
Okay, short answer, I promise. The vast majority of institutional investors today around the world are saying that there's a huge opportunity in the US right now, and I would say that it will probably absorb half to 2/3 of the capital flow globally. We'll just at least say kind of people looking for more private equity real estate type investment. Next in line would be Asia, and it's probably, you know, I don't know, what did I say, half to, 60% North American. I'd say probably, 20-25% will end up in Asia. Surprisingly little, I think, is going to go into Europe, which, one reason I say surprisingly little, there are a lot of investors who are saying it must be a huge opportunity given the kind of dysfunction and the distress in the market, but I'd say over the foreseeable future, most investors have assumed the crash position as far as Europe is concerned for now, and they will get in, but probably not right away. And I think you're probably going to continue to see, kind of somewhere roughly 5 to 10-ish% going into Latin America. When you really think in terms of the trillions that go in, it's probably more like 5%. And there'll be there are institutions that are now starting to look into Africa, and I know South Africa probably will absorb most of it. But when you think about where the real money's going, people want to be in liquid markets today, kind of London, not even rest of UK, New York, Washington to a lesser degree. What's really interesting is if you go to major cities anywhere in the world, you can go to Beijing, you can go to São Paulo, you can go to New York, you can go to London. Cap rates on prime office buildings in these markets are almost identical. And when you think of the different risks you have in China, North America, South America, Europe, people buying prime assets today in every major market are not really differentiating the risks other than I want to own a really shiny building in a major city. How's that?
Very good, sir.
That was a 2-minute tour of the world.
Couldn't have said it better myself. Well, thank you very much. Thank you, panel. You guys were great.